RMC Switchgears Ltd. Quarter 2 fiscal year 2026 financials are finally out. Today we're going to take a look at those financials and its future growth outlook. Okay, so first, before we look at the financials, here's the profit and loss statement. Look at this. H1 fiscal year 2026, H1 fiscal year 2025. H1 means the first half, meaning the first 2 quarters. RMC Switchgears actually does not release quarterly earnings, they release half earnings. So the first half of fiscal year 2025, we're going to compare it with first half of fiscal year 2026, the latest earnings. So the revenue increased from 104.78 crores in first half of fiscal year 2025 to 221.61 crores, 111.5% growth. All right. Now, their EBITDA only increased by 71.4% from 19.8 crores to 34 crores. So EBITDA also increased a lot, 71%, but it grew way slower than revenue. Okay. Profit before tax increased from 14.95 crores to 26.9 crores, 79.93% growth, still slower than revenue. And the profit after tax grew from 10 crores to 20.5 crores, presenting a 97.93%. So revenue grew the fastest. Profit after tax actually grew faster than EBITDA because the tax expense, here you can see, taxes grew by only 42.12% from 4.82 crores to 6.85 crores. So great revenue growth, but EBITDA and profit actually lagged. So is this a future problem for the company? They've actually provided clarification on that. But before that, some more ratios, okay, some more financial data. So first, we will look at the debt to equity ratio. So debt to equity ratio was 0.13. All right, it declined from 0.21 in first half of fiscal year 2025 to 0.13. That is a good thing. Current ratio, current ratio after this trend of decline actually reached to 1.57 in first half of fiscal year 2026. Okay. Now, very importantly, look at this. Accounts payable and collection period and inventory and net working capital period. These terms are very important for assessing a company's efficiency towards cash collection, okay, and towards the working capital and cash flows, future cash flows. So they're important in that regard. Now, the inventory days, how long does it take to convert inventory into revenue? It's around 31 and is pretty stable. Overall, it's pretty stable. And then the net working capital days, how long does it take to convert the working capital? Working capital is the money that actually funds the business operations. Okay. So the working capital days, how many days it takes to convert working capital into cash, has seen a steady decline to now 60 days in first half of fiscal year 26, declined from 101 days. So the lower this number, the way better it is for the company's cash flows. Okay. Then accounts payable and collection period. So collection period means number of days it takes for a company to collect money from its customers after it has already supplied the product. Lower this number, the way better. Okay. It means the company is able to collect the money faster from the customers. So 110 days in first half of fiscal year 2026 compared to 168 days. This is good. This is good. And accounts payable days, here a number of days it takes for the company to pay its suppliers. Longer this number, the better it is because it means they can delay their payments. They can collect cash from customers first and maybe potentially pay them to the suppliers later. That's a good thing. It's been on a rise from around 73 days in first half of fiscal year 2025 to 81 days in first half of fiscal year 2026. So overall, nice. Here's an earnings snapshot of the company for the past few years. And now we will take a bit of a deeper look. So, this was a statement by management from the whole time director and the CEO of the company. Let us zoom in. So, he said that the first half of fiscal year 2026 has been a clear validation of the strategy. So, the performance was in line with what they expected, in line of what the strategy is. Okay. Second, we will take a look at this. The interest coverage ratio, very important, EBITDA upon interest payments. If it's less than 1, that's concerning, was nearly 5 times, very healthy. DSCR, debt service coverage ratio, which is again EBITDA upon interest payments plus principal payment of the loan, was 4.4 times. Usually 1.15 times is the benchmark we benchmark, the benchmark number we look at when assessing the debt service coverage ratio. More than 1.15, more than 1.5, it's seen as decently good. So 4.4, very, very healthy. Then the movement of EBITDA margins from 19.4% to 15.6% decline in EBITDA margins was intentional and aligned with the company's strategic focus on expanding profitability in absolute terms. So margins declined, but this was in line with the strategy. They expected this. They're looking for this. Why? Because they're looking for increasing the profit in absolute terms. We saw profit after tax increase by 90%. That is still a big number. If it was in line with EBITDA, if profit after tax was in line with EBITDA, it would be growing around 75%, which is still massive growth. Not as fast as revenue, but they're looking for expanding profits in absolute terms. Absolute, not relative. Then, very importantly, their ongoing tender activity has exceeded 1,500 crores. So, from this, what I understand is that their tenders, meaning future orders they're looking to bid for, they're evaluating, they're looking to bid for, currently exceeds 1,500 crores. So, 1,500 crores of future work they are currently bidding for, looking for. They don't have it, but they're bidding for. Finally, the 1 gigawatt solar module manufacturing plant in Jaipur is moving towards post SIDBI sanction. And if you're wondering what post SIDBI sanction means, post SIDBI sanction refers to the stage after the Small Industries Development Bank of India (SIDBI) has officially approved a loan application or financial assistance, issuing a formal sanction letter. So they have approved a loan. I guess as a summary, they've approved the loan for their 1 gigawatt solar module manufacturing plant in Jaipur. With this new SIDBI sanction, that is approval for funds, they're well positioned for the next phase of backward integration and margin enhancement from fiscal year 2027 onwards. So margin enhancement from fiscal year 2027 onwards. Okay. And finally, for the first half of fiscal year 2026, what was the revenue segmentation? Revenue came from which business segments, which products? So, the electrical product segment contributed 49.66 crores, that is 22% to the total revenue in first half of fiscal year 2026. We have smart meter enclosures, feeder pillars, distribution boxes, electrical panels. Hold on. Yes. Then the margin profile here was 9% EBITDA margin, I'm supposing. Then the electrical EPC. So, what is the difference between electrical products and electrical EPC? See, electrical products, they're just selling the products. Electrical EPC, they're engineering the products, they're manufacturing, engineering the products, and they're installing it for their customers. EPC, engineering, procurement, construction, that's a full form, they're installing it. So, power trading and distribution infrastructure, smart grid and substation automation, special electrical projects. They're installing this stuff, this extra stuff, and margin profile 18% are the margins, contributed 26% of revenues. So this is the higher margin stuff because it involves more work. And finally, very impressively, the solar EPC stuff, where they are actually installing, let's say, solar panels, solar pumps, rooftop solar, contributed 114.46 crores in first half of fiscal year 2026. 52% of the top line, that is revenue, came from here. 17% is the EBITDA margin. And very importantly, very impressively, this segment, the solar EPC, contributed only 1.4 something crores, only 1.4 something crores in the whole of fiscal year 2025. This is the company's latest revenue segment. They just introduced this. They just introduced the solar EPC segment, and it already went from 1.4 crores in fiscal year 2025, as far as I remember, to 114.46 crores in fiscal year 2026. So you can see new segment, good margins, 17%, nice. Overall speaking, nice. And if you want to know about the company's future, like the many years earnings prediction, do watch the video on the screen, and that is it. Bye.